Life Trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. I have the blessing of being joined by my dad, Ed Reed. What's going on, Dad?
Hello, Brad, and hello, real life traders everywhere. It's a beautiful, sunshiny day here in Austin, Texas, and great to be with you all on the session this afternoon.
Awesome. Glad you're here. I got David Barron and Justin Lindermeister in the house. So let's go ahead and get going. This is our last session that David said. Yeah, it's our last one. So I'm kind of happy to get it all done and get the complete package out there, but I'm also sad because this has been a little bit of fun. But I'm not stopping. There'll just be something different coming up. So this is the last video of the Financial Fundamentals series and kind of the final objectives on how to kick it on over the hill, so to speak, for your financial success, and also how to be sure you don't roll back down the hill. Again, the lawyers out in California want me to remind you that all of the stuff in the Financial Fundamental series is considered entertainment, and hopefully some of it is educational. But it is not specific individualized advice. So if you do need such individualized and specific advice for your situation, please seek a competent professional in your area. And if they need to be licensed, be sure that they are licensed. Okay, again, the whole Financial Fundamental series is all focused on, first of all, make sure that you form your financial decisions together with your spouse or partner or whomever, but be sure that you make these financial decisions together and it's not just one person making a decision and then forcing it upon the other. You can only be successful if you are prepared. And a lot of the tools and techniques through the Financial Fundamentals series are about helping you become prepared. A big part about being prepared is having a plan. A budget is a plan, a retirement plan is a plan, of course. Funding your kids' college fund, you need a plan. We talked about different insurances, those are plans. We talked about estate planning, that is obviously a plan. So you need to have all of these plans in place so that you can be prepared, and when the opportunities come, you can capture that success. A big part of this is spending less than you earn, and a budget is a very crucial tool to doing that. But yeah, you must spend less than you earn, and retirement is not an age, it is not a right, it is not guaranteed. You can retire as soon as you are spending less than your money grows after inflation. So you can't really control inflation that much, but you can learn to invest or hire very savvy financial advisors and grow your money very fast. If you have a lot of money, it tends to grow very quickly. And then, of course, you control your spending. So there's a lot of different levers and things that you can do to adjust if you want to retire sooner or if you want to retire later. All up to you. Linderman says, if you haven't yet, could you build a checklist for each item you've gone over to be financially secure? Yes, I will do that. And my dad's got an idea how to stay out of these situations, right? So this financial series has been all about how to get out of a bad situation, but what if you are not in a bad situation? How do you stay out of it? Sounds good. All right, guys, yes, I will take those requests. Okay, so once again, we started off with the preparation. It was more just understanding some key concepts about money, what to do with your money, what not to do with money, and just sort of getting a new perspective on what money is and how to use it. And then we went into kind of three, I call them pre-game financial necessities. But before you're really going to go out and start crushing it and be really good with your money, you got to have a will, you got to have the right insurances, and you got to have a budget. Very, very crucial in order to be successful. And then if you are in debt, you need to get out of debt. If you don't have an emergency fund, you need to build that. And of course, wait for to build the emergency fund until you are out of debt. If you're out of debt and have an emergency fund, then you need to get on schedule to reach your retirement goals. And of course, we talked a lot about inflation, and we used a calculator that's a free calculator out on a website on reallifetrading.com, where you can calculate what your inflation-adjusted retirement goal needs to be, what rate of return you need to seek, and then how much you need to contribute each year or each month. And then a very similar tool, Investing Children's College. And I'm just going to say it one more time. My kids are 2 and 5, and they're looking each of them about $250,000 for a 4-year degree at a public in-state university, living on campus, just about as cheap as you can get, $250,000 each. And then, of course, this video is about the final objectives. There's a lot of really cool free stuff over at reallifetrading.com, from free trade setups to education on how to trade, whether you're a beginner, seasoned pro, any type of investing style. Lots of articles and lots of future videos, and even more stuff will be coming as soon as this Financial Fundamental series is in the books. In this video, we're going to talk about the next steps, which is if you're on schedule for your retirement, if you're on schedule for your kids' college goals, the next thing to do is to pay off your house, grow your wealth, talk about a few different tips and tricks on how to compare different investment opportunities. It's very important that you celebrate and reward yourself for the good behavior that you have, because if you reward that good behavior, you subconsciously reinforce it and you'll do more of it. Also, you definitely want to give to others and help other people. And then a couple of never forgets and final thoughts to wrap up the video. So after you are out of debt, you have built your emergency fund, you are on schedule to achieve your retirement, your inflation-adjusted retirement goal, you are on schedule to have your kids' college funded. If there is money left over in the budget, or you have completed some of those previous objectives and now you have money left over, paying off your house is the final step. And once you get your house paid off, think about all the money that you would now have left in your budget to either invest, to give, to go have fun, to live that life that we've always dreamed of. Imagine no credit cards, no car payments, no student loan payments, no payments of any kind. Unfortunately, you still have taxes, but that's about it. Everything else is fun. Just look at your paycheck and imagine, what if I could spend every single dime of this paycheck on fun stuff? That's what you get to when you can pay off that house. Now, I'm going to leave it up to you if you want to pay off the house before your retirement is completely funded or your kids' college fund is completely funded. Realize that once you have the money in an account and it's growing, you may not need to contribute each month in order to hit your goals by the time your kids get to college or by the time you hit the age that you want to retire. So if you want, you can throw extra into each of those, but definitely want to get to work on paying off the house. Now, how you do that, at a minimum, once your retirement is on schedule and once your kids' college fund is on schedule, you can make one payment each month for 1/12 of the monthly payment or more. Feel free to kick in more and get that thing paid off quickly. But this will avoid a massive amount of interest payments that you would end up having to make. It also reduces your risk. It builds equity in your house. If you ever are going to sell it before you get it paid off, it just makes things so much easier. So on that extra payment, me and my wife, we make the mortgage payment at the beginning of the month. So that extra 1/12 payment could be in the middle of the month when that second paycheck comes in. We get 2 paychecks a month. But be sure you put principal only on the check for that extra payment. And that'll also distinguish it from your regular mortgage payment. I actually got foreclosed on a house I owned when I made my payment. So it was due on the 1st, and I made the payment on the 28th and of the previous month, not that month. I paid it about 3 days early, and I get a foreclosure notice, and so I call them up. And I don't remember the exact name of the mortgage company this was, but the initials were GMAC. And I said, hey, I made you guys a payment exactly what you wanted, the exact to the penny, and you guys still foreclosed on me. And they said, oh yeah, we took that one. We didn't know what to do with it, so we just put it towards the principal. So you still haven't made your payment. And so, yeah, that's why we are foreclosed on your house. And I made a comment, something like, wow, that'll be great when a jury of my peers hears that I paid you exactly to the penny 2 days before it was due and you still foreclosed on me. I've always wanted to own a mortgage company. And there was a little bit of a pause, and then the lady said, okay, we'll get that taken care of for you. And I was like, yes, you will. So realize these mortgage companies, they're dumb. I'm sure the people that work there are very smart and intelligent people, but the systems, computers that these poor people are forced to use are fairly dumb, and that makes it really, really inconvenient for you and me that have mortgages. There are a lot of offers that I get in the mail, and they always say, hey, if you pay us some money, we will allow you to make an extra mortgage payment. So you can pay, pay twice a month, and then you end up making 26 payments, 26 half payments in a year instead of 24, I don't know, instead of 12 full payments, you make 26 half payments, so you end up having an extra payment in the year, and that helps you, blah, blah, blah. But they want to charge you money for all that. Don't ever do that, okay? By law, the banks are required to allow you to make extra payments towards principal, okay, by law. So if someone wants to say, no, 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 you have to pay money to get into this program, they're scam artists, or they are, they're scam artists. So just avoid those people. And also never give anyone electronic access to your account. I had a mortgage company one time say, hey, we'll give you a discount on your rates or whatever it was if you give us electronic access to your account. And they gave me this interesting contract, which I actually read. I usually don't read those, but I did. And I said, there's nothing in this that's going to keep you from just wiping everything out of my my bank account. This basically gives you unlimited access. And I'll never forget the lady said, and the bank name sounded a whole lot like Huntington. They said, we usually don't do that. And that was the best assurance that they gave me. So I advised them they could go fly a kite. So guys, look, these mortgage companies are idiots. I actually had a mortgage company once that was doing escrow for me. So escrow means they take your taxes and your insurance payments, and you make one payment each month, and some of the payment goes towards your mortgage, some goes towards your taxes and insurance. Well, one month they doubled the mortgage payment. They doubled it. So I called them up and was like, hey, what's going on? What do you guys do? And they said, oh, I'm sorry. We miscalculated your taxes and your insurance, and so you're behind. So you need to get caught up. So we're going to double your mortgage payment. And I, argued with him. I said, how many people do you know that you can just double the mortgage and they can fit that into their budget? And anyways, we had an emergency fund, so we just got caught up on the taxes and everything was good. But having a mortgage, I know most of the time it works well, but holy smokes, when these people mess up, and they do mess up, they have messed up at least 4 times in the 12 years or so that I've had a mortgage. When they do mess up, it's painful. So pay off your house, get rid of those folks. Realize that your debt is guaranteed to grow and investments are taxed and are risky. I know a lot of people say, but hey, Brad, if my mortgage is at a 4% interest and I can invest to get an 8% rate of return, then I should pay my mortgage payment but keep growing, because I can outperform the debt, right? The rate of growth is higher than the rate that my debt is growing, so I come out ahead. But what that does not include is that 8% is not guaranteed. It goes up and down. And also that 8% is taxed, so it really comes out to be more like 5 or 6%. And then again, the debt is guaranteed to grow whether you do well in the market or not. So go ahead, pay off that house, get rid of it. It's not worth that extra 0.5% or 1% you might be gaining because you can invest at a higher interest rate than your mortgage interest rate. You've been working really hard to get rid of all those ugly weeds in your financial yard. The house is just that last one. It's a big one, but get out there and dig it up and pull it and get rid of that last final debt. Also, you can eliminate lots of stress and obligation. It said that the house sleeps better and the grass feels better. The grass grows better if the house is paid off, and that is absolutely true. And here's another thing: if you pay off the house and you're completely debt free, and you want to go back into debt, they'll let you do it. You can go get a home equity loan or whatever you want. If you have your house completely paid off and you're completely out of debt and you want to go back into debt, that is really, really easy if you decide to do that. Remember, debt is the opposite of freedom. All right, you've always heard the term the rich get richer. Well, now's your time to live it. So you can do that by putting extra into your emergency fund. My family just did that. Remember, as inflation causes the cost of living to go up every year, it's likely that that your expenses are going up every year, and so you need to be sure that you grow your emergency fund just a little bit every now and then to make sure that it keeps up with all of your expenses. You can also hire a financial advisor, open an account, and put money in there and grow that money just as fast as you possibly can. Learn to trade. Guys, the potential of successful trading is enormous. Okay, in just 9 months, the credit spreads that we have on the swing trading floor is up 371% of the amount risked. Okay, so that's not the whole portfolio, but if you started off and let's say you wanted to risk $5,000, you'd be up 371% on that $5,000. We do have a swing trading floor, and that one is up 55% of the entire portfolio in just 3 months. So if you started off with $10,000, you'd be up about that $10,000 that you started with 3 months later would be at about $15,000. For day trades, we're up 186% of the entire portfolio in 9 months. Again, if you started off with $10,000, you would have doubled it to $20,000, and you'd be up well over $30,000 in less than a year by starting with $10,000. But you got to learn to trade. You can't just copy the trades that we do because things move, and you're going to have to play defense. You're going to have to take at targets before we can communicate with you. But learn to trade, and you can go to www.reallifetrading.com, and all the education there is free. If you want to copy our trades and you want to watch us, how we trade with real money, you need to sign up for the live trading rooms, the trading floors. And just today, in fact, the day trading, we're up 4 times what we risk. So if you were risking $100, you'd be up $400 just today. If you're risking $1,000, you'd be up $4,000 just today. Now, when you have amassed a lot of wealth and you're growing that wealth quickly, get rid of insurances that you don't need and raise the deductibles on the others. You know, maybe you have a $250 deductible on your car insurance. Well, if you get into a car accident, you know, maybe you can pay $1,000 now, and it doesn't wreck your financial world. So raise that deductible and lower insurance costs. If you have a $500,000 insurance policy, and at this stage of your financial world, you have $500,000 in assets, well, you don't need that life insurance anymore because that life insurance was there to pay money to your survivors in case of your death. Well, if you can leave $500,000 in your will to those people, then you don't need the life insurance company to do it. So cancel that life insurance, but only when you have enough assets to support your survivors. But yeah, you can save a huge amount of payments by just canceling the life insurance. When you are ready, when you have financial asset or in your investment fund. Sounds like my microphone is breaking up. There we go. Okay, so you can cancel your life insurance once you have enough assets to support your survivors in case of your death. You don't need life insurance. That's what life insurance is for. Apply for investment opportunities now that you did not before, like hedge funds. And then one of the favorite investment opportunities is rental houses. Now, I'm a big proponent that if you are going to get into rental houses, you need to buy the house in cash, or at least put down 80 or 90% of the money in cash. Because if you have to pay for, if you have to replace an air conditioner, or you have to replace a roof, or some big expense comes in on that rental house, and and you're having to pay a big chunk of the mortgage, it can really hurt, and it can wipe you out. I had a buddy that had about 9 or 10 rental houses, and he paid all of them on just about 100% debt. And one of the houses, he didn't get an occupant in it for about 3 months, and another one, a pipe broke and flooded the house. And the cost of all that caused him to get foreclosed on, and he ended up losing all of the houses. So if you do the rental houses, be sure you pay for a big, huge chunk of it, if not all of it, in cash, But the cool thing about a rental house is not only does it pay you monthly, but it goes up in value. Generally, houses go up in value. So you have an asset that's going up in value, which is nice, and it's paying you monthly. Rental houses are awesome. Okay, when you have all of these different opportunities and all these different investment opportunities, you need to learn how to compare them. Realize that the market goes about 10% year over year on average. Hopefully at this point you have a financial advisor that is investing for you and you understand what that financial advisor is earning year over year, and or you may be trading yourself and you know what your year over year growth is. So if someone says, hey, I have this new investment opportunity, you know how to compare it. You can compare it to the market. You can compare it to your financial advisor. You can compare it to your own performance to see if it's a good opportunity or not. I have a buddy that bought some stock about 9 years ago. I think I talked about this. I talked about it yesterday. Yeah, bought some stock about 9 years ago, and he's so excited because it's doubled in value. Well, as we're about to see, it's actually underperforming the market. Realize that inflation grows about 4% on average. So if you have an investment opportunity that's not even outplacing inflation, it's not a good investment opportunity. And then I did hear a statistic. I heard it. I did not verify it, but I heard that someone took a grouping of 30 years since like 1914, 1912, something like that. And the highest average inflation over a 30-year period has been 5.44%. So now that you are in, now that you've gotten all of your retirement funds on schedule, your kids' college fund is on schedule, you have either paid off the house or you're paying a whole lot more on the house, you may want to go to some of those different investment funds, your retirement fund, and see what would happen if inflation was at 5.44%, and maybe you want to make that your new target. Just an idea. But here is, I want to talk about the law of 72 that you may hear about, and allows you to determine either the interest rate or how long it'll take for an investment to double. And basically it looks something like this. The time for an investment to double is 72 divided by the interest rate percentage. So say for instance, if you had an interest rate, 7.2%, whatever you had would double in about 10 years. All right, up above it says the market grows about 10% year over year. 72 divided by 10 is 7.2 years. So if you had an investment that was growing at 10% year over year, you could expect it to double about every 7 years. Inflation grows at about 4%. So 72 divided by 4% means the price of everything that we buy is going to double at about every 18 years, because 72 divided by 4 is 18. Now, on the other hand, you can switch the interest percentage and the time to double, and you can say, hey, you know what, my buddy had an investment that doubled after 9 years. Well, 72 divided by 9 years is 8%. So we can understand that he was underperforming the market. So there's probably better opportunities out there. I had someone that bought a musical instrument, and after about 20 years, the thing had doubled in value. Wow, that sounds pretty cool. Well, 72 divided by 20 is what, a little over 3? Great, 3%. Didn't even outplace inflation. Inflation grew more than the value of that investment. So it's probably not a good investment. Now, maybe you were playing and enjoying the musical instrument. It was worth it, but as far as an investment goes, not so good because you didn't even outpace inflation. So here are some interesting ways to better understand the value of an investment opportunity and compare it to the market, to inflation, to your own performance. And here's an advantage. I guess I just used this one. An investment doubles every 10 years at 7.2% interest. An investment paying 9% will double in 8 years. That was my buddy's. And here's an interesting one. This is a big one for me. And I'll let you guys on the floor answer this. What monthly interest rate is needed to double an account in 12 months? So start doing the math. Basically, you're going to use that formula there on the right. 72 divided by 12 months equals 6% per month. So if you can get 6% each month you will double your account in a year due to compound interest. Now, 6% is 3R. 6% a month is, I was going to say easy, fairly easy. A competent trader with credit spreads can easily double their account, excuse me, not easily. A competent credit spread trader can double their account in a year just by hitting 6% in a month. A trader that hits 3R in a month will double their account in a year. So I think that number is pretty cool. All right, celebrate. If you have your all your debts paid off, no student loans, no car payments, no credit card payments, you have built up an emergency fund that's 3 to 6 or 9 months of expenses in case you lose your job. You can still fund your family until you get another job. If you have your retirement fund on schedule, you have your kids' college fund on schedule, you're paying extra on those, you're paying extra on those, go ahead and reward yourself. Go ahead and buy that toy or go on that crazy vacation. Just be sure you do it with cash. And if you don't have enough cash flow in 1 month, put it in a separate account and grow that account either with interest, buy some really low beta mutual fund if you want that pays a little bit more than a savings account. Let a financial advisor grow it, trade it yourself. But once that account gets up to however much you need, then go buy the toy. It's okay, you can do it. I know for me, when I get there, when the kids' college fund is completely funded and the house is paid off, I'm going to go buy an M3, a BMW M3 myself and my wife. I'm going to get her a BMW X5. Although the last time we talked about it, she said that she wants a sports car too. So that may change, but I don't know. We're many, many years or decades away from that. And another thing that's really important is giving to others is the secret to happiness. If you want to identify who are the truly happy people in the world, you will very often understand that money has very little to do with it. The happy people are those that give to others. Whether you give financially, give time, whether you give love, whether you give information, the happy people are the ones that help others. We all know that money does not buy happiness. I'm telling you right now, giving to others and helping to others does buy happiness. And if you don't believe me, try it. So if we want to talk about financial gifts, you can, I know one of my friends got some big, huge, ginormous chunk of money from their work when their work got bought out. They were like number 6 person to ever work for that company. When it got bought out, she went and she funded her nephew's college funds. Maybe you want to give someone some seed money to start their retirement fund. Maybe you really like your financial advisor and you know someone is behind on their retirement. So just say, hey, look, I put $50,000 in this retirement fund for you to be managed by Lauren Olson at Retirement Resources. Talk with him, get everything in your name, and then start contributing to that. Now, I will say only reward good behavior. If you've got someone that says, oh my gosh, I'm so sorry, I racked up $20,000 of credit card debts, I need help, please, please, please help me pay off my debts. If you pay off those debts and they don't change their ways, they're just going to get into more trouble. They're going to get into more debt, and they might get into like some serious, serious trouble. So be sure that before you go help someone, that they are on the right path to be responsible with that financial gift, and that they can grow that gift and then eventually pass that gift on to someone else. Be sure you are not rewarding someone's bad behavior, reinforce someone's good behavior. One idea, I know a lot of people do this, is they say, hey, if you go read this book about how to get out of debt, or maybe if you go watch these videos and write up a book report, I'll pay you $100, or I'll pay you $1,000, or I'll pay off this debt, but only after you come up with a plan and a budget on how you would pay it off yourself. Something along those lines. Feel free to give to charities. The most happiness is when you can see the people that charity helps. So if you want to give to the United Way or the Red Cross, those are admirable organizations, but you're probably not going to get to see the people with your eyeballs. But if you go down to the local food shelter, or if you go to the Goodwill or whatever, you can generally see the people, and that increases your level of happiness. Here's another idea that I like. I know a lot of people like giving large chunks of money to schools or to charities or to churches, and that's great. If that's what you want to do, go for it. I'm by no means saying stop, but here's another idea. Whenever those institutions get that large chunk of money, they usually spend it in about 2.5 minutes. Granted, 78% of statistics are made up on the spot just to prove a point, but they spend it and it's gone. What if instead of giving a big chunk of money, what if you put that in an account and either grew it yourself or let a financial advisor grow it, and then the proceeds each year from that account, however much it grows, adjusted for inflation. So if it grows 10% one year, take 4% of that, keep that in the account, but take the remaining 6% and give that to someone. Give that to a charity, give that to a church. But what you've done is you've created a fund that will give a meaningful amount of money forever, way beyond your life, because every year as inflation causes the cost of living to go up, that fund will go up by the same amount. And that fund will keep giving and giving and giving and giving. And this is what you want your retirement fund to do. So it's kind of like you get to practice for your retirement. Put a chunk of money in an account and see how well you can grow it. Leave 4% for inflation in it, but whatever it grows beyond that 4%, give it away. And maybe you've got a charity or a church organization that sometimes you don't think is that responsible. Well, guess what kind of leverage you get when you let them know, hey, I've set up account, and my plan is to give you guys, however much it grows every year, as long as you don't go off and do something silly. So just food for thought, a different way to give, a meaningful amount of money that will not get spent all at once, but it will be a gift that can give year over year over year, and it allows you to practice for your retirement. You can always give the gift of time and love, and of course this is very, very needed. Teach someone to do what you accomplish, whether that's get out of debt or you learned how to trade. Go teach someone else. It's very key to achieving happiness. Be a coach or support system for someone else that's going through it. We probably all know people that are suffering in debt. Go to them and say, hey, look, I was just right here, and this is what I learned, and it's really helped me and it's helped us. I don't know, it might be good for you too. If you want more information, if you go to reallifetrading.com or do a search on YouTube for real life trading, real life trading and financial fundamentals. If you have any questions, let me know, but it's what we did and it was a life changer. It was a life changer for the better. Check it out. And then if they say, hey, wow, that's pretty cool, I appreciate that, we're going to go through that. Share with them all the tips and tricks. Remind them when they're doing the budget that that thing's a mess, and that takes 3 to 6 months before you really get good at the budget. So be patient. Remind them that, hey, you know what, this only works if you make decisions with your spouse, with your husband or wife or whatever. You got to make those decisions together. One person can't do it, and then force it on the others. But share with what you learn. And then I know a lot of people that like to volunteer, and they do minimum wage work. And if that's what you want to do, by all means, go do it. It's needed. People need it. But if you're a successful trader and investor, remember that 1 or 2 trades that you can do in an hour or 2 or 3, you can hire a lot of people to do some of that minimum wage work. So just consider the value of your time. Is it better spent going out and digging ditches for someone who needs a ditch dug? Or should you make 1 or 2 trades and then with that go hire 10 people? Just an idea. All right, just a couple of more things before we wrap up the whole entire series. It makes me sad. Be grateful for what you have and work hard for the things that you don't have and want. But very important, be grateful for what you have. There will always be someone with more. There will always be someone with more money, or with more houses that are in better neighborhoods, or they have better clothes, or they have better hair, or they have better whatever. There will always be someone with more. Don't chase it. Okay, be grateful for what you have and work hard for the things you don't have. Some of you guys know I was in a band called Matson Bell, and one of the most impactful quotes that I heard from Katie was she had gotten nothing that she hoped for, everything that she had worked for. You guys have worked really, really hard to get to this state of financial success. Don't throw it away. Okay? Be very careful with what you have accomplished. Here's another thing that I hear a lot of people get wrong is say, you know what, I was on my way home and I saw the sporting goods store was having a sale, and so I went in and I bought a new football and a new basketball, and I saved a lot of money. Or, I was on my way home and the purse store was having a sale on purses, and so I bought a new purse and saved a lot of money. No, you didn't save anything. Okay, a sale only saves you money if you were going to go buy that thing anyway. And actually, last weekend, my wife said, "Hey, you know what? I need some new pants for work." And my wife has a job where she's sometimes presenting to presidents, vice presidents, and sometimes she's on the manufacturing floor. So she needs a lot of different wardrobe. And we said, okay, well, let's spend this much money and let's go buy 3 pairs of pants. And she said, I know exactly what I want. This is how much they cost. And so we went to the store and we're going to check out, and it turns out there was like a 2-for-1 deal, or I don't know, there was a bunch of stuff on sale. And so we saved money. But the reason we saved money is not because we went and bought things that we didn't need. We were getting things that we didn't need, but they cost less. So don't get carried away and say, oh, something that I've kind of been thinking about is now on sale. I'm going to go get it and save money. That's not how that works. You're spending money that you would not have been spending. That is not saving money. Saving money is only when you were going to buy something anyway, and now you get it at a lower cost. Linderman, the first one, Matson Bell, Matson-Belle. Financial independence is like running a race, except every year that you don't finish that race, inflation and time are moving the finish line further away from you. So imagine, my wife just ran a half marathon a few weeks ago. Imagine if you were running that half marathon, and every 10 minutes or whatever, they moved the finish line further away. Would that motivate you to kind of kick it up and run a little bit faster so that you could get it over with? Absolutely would. Well, your retirement goal and your kids' college funding goal and your other investment goals are the same way. Because every year that you don't hit your goal, inflation causes that goal to be just a little bit bigger. And you also lose one less year to grow the money. So as time goes on, that finish line keeps moving further away. So the whole point of this sentence is, look, if you have goals that you're trying to hit for retirement or kids' college, don't get distracted. Don't get lost. Buckle down. Fund the account. Get that money in there as soon as you can. Because if you're 30 years old, maybe you can retire, or maybe if you're 30 years old and you have $200,000 in an account, maybe you don't need to put any more into retirement. Maybe you're done. But if you wait till you're 50 years old, $200,000 ain't going to cut it. You might need $300,000 or $500,000. So the sooner you get that account funded, the less amount you need in that account, because you have a whole lot more time to grow it. So every year that goes by that you have not hit that funding goal, that goal actually gets bigger. So buckle down and get those retirement funds funded, the college fund funded, get the house paid off, and whatever investment you have, get those funds funded as fast as you can. Now, if you can get money in that account and you can get it quickly, compound interest will grow your money faster and faster if you let it. Remember the analogy of money doesn't grow on trees, money grows like trees. The longer that tree grows, the faster it grows. Or if you like the analogy with the crop of sunflowers, right? If you plant one seed and a sunflower grows and you take all the seeds and you replant those, then you get 10 or 20 more, and then you take all the seeds from those, and then you have a crop of 100. Your money's like that. Let those seeds reinvest, regerminate, and that's compound interest. And you can retire when that money is growing faster than you can spend it, accounting for inflation. Guys, you only get one shot at retirement. One shot. So I aim for a higher amount than I actually think that I'll need. So even if I'm 50% wrong, 80% wrong, or if I come up short, I'll still have a pretty good amount in retirement. But you only get one chance at retirement, so be sure that that is taken care of. Be sure that your retirement fund is taken care of before you work on kids' college fund, before you work on paying off the house or other investment goals, fund money, etc. Get that retirement taken care of. Keep your focus on that retirement. Don't lose focus. Here's another thing to remember. 80% of millionaires are first generation rich. That means most of the rich people that you know, they worked really hard to get there. Okay. Now, another part of that 80% of millionaires are first generation rich means a lot of the people that did get rich lost it. So remember the financial fundamentals that got you to where you are. Don't lose them. Okay. Stay vigilant. Don't start spending like crazy. Be mindful and be careful with your investments. Don't get too crazy. Always be able to spend more than you earn. Always use a budget. I don't care how much money you have, how much money you get. I don't care how rich you are. If you make Donald Trump look poor, if you make the Kardashian families look like they've got chump change, you still need a budget because you will always be able to outspend that money that comes in, always. Because as soon as you buy the most expensive of whatever it is, someone's going to go out and make one even more expensive. Stick to your financial fundamentals. And guys, don't ever forget, you and your partner did it. Your partner helped you. Your partner supported you. You supported him or her. He or she supported you. You learned new ways to think about money. And that's kind of what started the whole journey. You got an estate plan and the right insurance to protect yourself and your loved ones. You did it. You did that. You got off the couch. You took time away from TV or from working out or from whatever else you were doing to go and get that. You did that. You accomplished it. You figured out how to create and use a budget. Most folks have never done this, so if you did it, you accomplished that. And remember, using and creating a budget, that's not easy. Okay, it's at least a 3-month exercise of pulling your hair out or turning your hair into gray hair. It's tough. You sacrificed a lot to get out of debt, right? You stopped going out to dinner, you stopped going to movies, you stopped a lot of the fun stuff. Christmas is coming up right now, so maybe you didn't give all the fancy Christmas gifts you wanted to, but you got out of debt, you did it, you achieved it, you accomplished it. You calculated and budgeted how much to contribute to retirement. No more just wild guessing and throwing some blind amount into some unperforming retirement thing. You calculated and budgeted how much to contribute to other long-term expenses, like your kid's college fund, like paying off the house. Think about all the people that their college fund is not going to be funded. When it comes time for them to go to college, they're going to have to cough up $250 million to get a 4-year degree. And you chose the financial advisor, and you learned how to trade, or both, to grow your money. Don't ever let anyone tell you that you don't deserve it or that you just got lucky. Folks, you worked hard. You made the decisions. You did it. That's your money. That's your accomplishment. And there's a lot in the politically correct world that we live in. There's a lot out there on social media. There's a lot in the mainstream media about how you're bad if you have money. And let me just give you my perspective on that. There's basically about 4 things you can do with money. One, you can give it. I don't know poor people that give money. Rich people give money. And rich people help people by giving other people money. You can also spend the money. So let's say I have a lot of money and I go buy a BMW M3. Well, I spent the money. But did it help anyone? Well, did it help the people that work on the manufacturing line that put it together? Did it help the engineers and the people managers and the HR managers that had to design the car and run the company? So there's a lot of people that I help by going out and buy a BMW M3. Yeah, it's a fancy car, it's a beautiful car, but I helped a lot of people that made that car and designed that car. So by spending the money, I don't have a BMW M3 now, but I hope to one day. But just remember, if you go and you spend a lot of money on a luxury item, you're helping every single person that built that luxury item. So you can help people by buying stuff. You can save money. If you have a lot of money and you put that money into a savings account, well, what do you think the bank is going to do with it? They're going to go lend it to other people. Now, granted, your money is insured, and so if something crazy happens, you should be able to get your money back. But even by putting money in the bank, you're allowing other people to benefit from it. And then, of course, you can invest it. You can invest it in a business, and you can hire people. My wife in her job saved a whole bunch of people's jobs. Every time, you hire someone or someone job is saved, but that's Christmases, that's birthdays, that's other people's retirement. So investing the money also helps other people. I'm coming up with a new concept and I'm going to write a paper about it, but basically I'm going to say that rich people don't have money, rich people control money. But if you are rich and you have a lot of money, sorry, I'm reading the chat pane here. Evidently I said it'll take $250 million for a kid's college fund. No, it'll take $250,000, $250,000. Thank you, Justin, for correcting that for me. But if you have a lot of money, that money is helping people, and you get to control how you help people. And you worked hard for it, and don't let anyone make you feel bad about getting there. Now, a lot of people that I know are watching this video are probably either Christian or Jewish or Muslim. And so I pulled some verses out of a book I call the Bible. But even if you're not a believer, I think a lot of people would at least give that book credit for having some good advice. But Proverbs 22:7 says the borrower is slave to the lender. And if you guys have been in a lot of debt, you understand the pressure that it takes to make that payment each month. And you may not get to do some of the things that you want to do because you have to make that payment. If you get into debt, free yourself like a gazelle from the hand of the hunter and like a bird from the hand of the fowler. That should be Proverbs, not Proverbs. But basically it says if you get into debt, get out of debt ridiculously fast. It also says, wow, I misspelled Proverbs a lot. I'm embarrassed. It says a good man leaves an inheritance to his children's children. Okay, a lot of these things are saying it's good, it's biblical, it's a good thing to live your life out of debt and with a sizable chunk of money, enough money that you can leave to your kids. Precious treasure and oil are in the dwelling of a wise person, but a foolish man consumes them. Again, save money. A wise person has money in the bank, has savings, has financial security. If anyone is not willing to work, let him not eat. For we hear that some among you walk in idleness, not busy at work, but busybodies. There's obviously a lot in the Bible that says giving. Giving is good. Giving is good, but give responsibly. Okay? Don't, again, it goes back to, this is a big part of where I came up with that concept of put a chunk of money in an account and grow it and give the proceeds. That way you can keep giving over and over and over again. And work hard for it, right? This says if you're not willing to work, you don't eat. The soul of the sluggard craves and gets nothing, while the soul of the diligent is richly supplied. The whole point of this is that you guys have worked hard to get where you are at this point of your financial success. You deserve it. Okay, it's okay to deserve it. You're doing good things. So now go out and do good things with the money. Okay, once again, make financial decisions together with your spouse. In order to be successful, you must be prepared. Have a plan. Okay, have a plan for retirement. Have a plan for your kids' college fund. Have a plan for each paycheck. It's called a budget. Spend less than you earn if you want to become financially successful, and you can retire as soon as your spending is less than your money grows after inflation. So you can really cut down on your spending, or you can save up a whole bunch of money, or you can grow that money really quickly, or all three, and then you're ready for retirement. Folks, thank you so much for watching these videos. I really appreciate every one of you, even just for watching. Some of you guys have emailed me. Some of you guys have asked questions. Some of you folks have just said a thank you. I know there's people out there that their marriages are better because of this. Their financial outlook is better. Some people said that they were on a disaster for retirement and now they're fixed. So I appreciate all of you guys for at least watching these videos. If you think they're good, share them with your friends. If you want me to come give a live presentation to your group, and I am able to, I absolutely will. So feel free to reach out to me, brad@reallifetrading.com. I've already had 2 requests to give in-person presentations since we started the series. But thank you guys so much for being here, for watching this. Again, all this information is free. Please go share it with everyone that you think could benefit from it. And man, I'm going to read the chat pane a little bit here. I appreciate that, David. David's been here just about every single one. Linderman's been here for just about every one of these. I know a lot of other folks have been here, so thank you guys so much. Okay, I've said thank you a lot. So I'm just going to leave you with this. Trade on logic, not on hope. Have a good one, everyone. And thank you.